silver at 73 to silver at 200. We could go, gold at 4,400 or slightly below to gold 7,000. When gold moves $4,400 on its way to 7,000, there are lots of people that would prefer to buy silver at $75. You could have gold at 7,000 and see it fall maybe to 4,000 or below. If silver goes to 200, and I'm right that that's where it goes to, silver could fall by more than 50% in a bust. So that's where I think you'll see the big correction. My longer term forecast for gold is 20,000. My long-term target for silver, which for a long time was $400 or $500, I raised that to 1,000 recently. The amount of silver required in all these new technologies, including AI, EV, solar panels, solar demand is growing. It's not shrinking. It wasn't just stock market, it was metals that got hit. So, and number two, the Iran war gave it an excuse to carry that. The first sell-off.
I want to start off and touch on an outlook where you are looking at $7,000 gold. So I wanted to ask you, how do we get there?
Yeah, so we've had quite a run here. Gold only a couple of years ago was back in the mid to low 2000s. And I've raised my targets a few times since then. I was at 3,400, and then I raised it to 4,000 and 5,000 and 5,500. And yesterday I raised my price, and then 6,800 in February after the sell-off. Yesterday I raised my target to 7,000. I think, a lot of it is monetary. We're obviously seeing all kinds of, money printing around the world, not so much short term here, but over time that's been the case. I think you're going to see a very weak dollar going forward. I think that will be part of the move from 4,400 up to 7,000. And obviously there's all kinds of geopolitics out there, and lots of reasons to have consternation about worldwide situations. So I think gold gets a bid under those circumstances. And the other metal, silver, also does. And I also raised my silver price yesterday.
The Fed keeps insisting inflation is cooling, while gold quietly doubled from levels policymakers once called temporary panic. According to David Hunter, the move towards $7,000 gold is being driven less by fear and more by structural monetary dilution happening across every major economy simultaneously. Central banks are still expanding liquidity through backdoor mechanisms while publicly pretending conditions are restrictive. That disconnect matters because average savers holding cash or bonds are absorbing the real cost of policy failure in slow motion. Next, David Hunter exposes why institutional money is moving into metals before the public narrative fully shifts.
I had increased it coming into 2026. In my first quarter letter, I increased to 125, and we quickly got up to 122 within weeks of that. And so when it sold off the first time, went down to the mid 60s, I raised my target from 125 to 180. And yesterday I increased my target to 200. So that's where I'm at. I know there are a few people out there higher than me, but not too many. Most, Michael Oliver's the high guy out there on the street talking about $300 to $500 and saying it could happen this summer. I think my 200 could happen this summer. Doesn't have to, but I think it could. And I don't, I can't get to 300 or more right now, but I certainly don't. I respect Michael's work, and if we get there, more power to him.
Yeah, it's a lot of different things to look at right now when we're considering the price action for the precious metals. And we'll definitely touch on silver, but I just wanted to ask you the current gold price. I think right now it stands at about $4,400 an ounce or somewhere around there. The current gold price, what does it do for you? Does it worry you somewhat? Does it excite you? What is it telling you where it seems to, be a bit then it's not moving as quickly. It's a bit more labored.
Silver collapsing from triple digits into the 60s didn't stop institutions from continuing physical accumulation behind the scenes. What David Hunter is highlighting is that volatility itself may be the mechanism shaking weak hands out before the next repricing cycle begins. Retail investors often interpret consolidation as weakness, while funds use those exact periods to reposition quietly through futures exposure and bullion acquisition. The real risk is not missing a short-term rally, it's being trapped in fiat assets while hard assets reset higher against declining purchasing power. Next, David Hunter reveals the hidden timing signal behind silver's violent reversals and why institutions rarely panic during them.
Yeah, well, I am forever telling people on X to stretch their time horizon and have stretch out their viewpoint to have perception, because I think you can, or to have perspective, because I think you can get caught up in the day to day, and it seems like forever if you're watching the price day by day. When it takes a month to move, everybody's going, "Oh, it's stuck in the mud. What's going on?" When you're looking at a picture that's 20 years or 10 years or even 5 years, you get an entirely different perspective. I mean, gold's had a great run from the low 2000s to 5,500 in a couple of years, a few years, and people then expect it to do that all the time. It's like and it is moving. So what we've had since February, we had, the big run up to 5,500. That was a big jump. I mean, we were down at 3,000 not long before that. So that was a big run. It needed to consolidate that. And it did that initially in February. And then the Iran war started right as March 1st came. And again, the metals are risk off. I mean, they are risk on. And so when the market decided, when investors decided it's time to take some chips off the table to reduce our risk because of what's going on in Iran.
This exact pattern showed up before prior commodity supercycles accelerated, sharp breakout, violent pause, then institutional re-entry after retail exhaustion. David Hunter notes that investors obsessed with daily candles are missing the larger macro transition unfolding underneath the volatility. Gold moving from $3,000 to $5,500 in such a compressed time frame already signaled stress inside the global monetary system, not speculative excess alone. Long-term holders protecting purchasing power are watching central banks accumulate while public attention stays glued to short-term geopolitical headlines instead. Next, David Hunter unravels why war headlines may be masking a deeper liquidity problem developing beneath the metals market.
It wasn't just stock market, it was metals that got hit. So I think, number one, it was a big run up. So it deserved a consolidation of a few months. And number two, the Iran war gave it an excuse to carry that. The first sell-off in February could have been it if we hadn't had Iran, but it probably makes more sense that it did need more time to consolidate. So I don't view it as anything but just a normal consolidation. I know there are people talking bearishly and lower prices, and it has to go back to whatever, below 4,000. I don't think so. I think we're very close to a turn here. Could be any day now. And I think it's off to the races again now. Obviously, Iran's still sitting out there as a problem until that, if we get a negotiated settlement and the strait opens up and oil prices come down and it looks like Iran's been resolved, at least for, quite a while, I think that will cheer up investors everywhere, stocks, bonds, metals, everything. So Iran's still kind of the big thing sitting out there that needs to get resolved. But, it's hard to know. The Iranians play games. They talk like they're going to, meet you and have a settlement. And then the terms change or they make ridiculous statements or what have you. I think you just have to let that play out. You can't guess it.
Markets sold off on geopolitical fear, yet physical gold demand never truly broke underneath the surface. This is where David Hunter's thesis shifts from emotional headline trading towards structural positioning by larger capital pools. If metals were genuinely entering a bear phase, central banks would not still be adding reserves while sovereign debt risks continue widening globally. The public story says uncertainty hurts gold, but historically prolonged instability exposes confidence cracks inside currencies first, especially for retirees relying on fixed income purchasing power. Next, David Hunter exposes why investors may be underestimating how quickly sentiment can reverse once liquidity conditions change.
But I do feel looking at the markets themselves, without trying to guess Iran, it does look like we're very close to a turn in the metals, and I think it will be off to the races.
That's a great point, because I think gold and silver, precious metals, they're basically a midterm investment at best, mid to long term. And I think what happens is we get caught up in the short term noise, and there may be 1,000 short-term incidents that will happen before you even hit a midterm, much less even a long term. So I think we lose sight of the long-term investment. But it's interesting with what you said about Iran, because say if things should calm down a bit, will we then see the fundamentals start to take over the psyche of investors, where right now we're seeing more monetary policy taking over the psyche of investors?
Oh, for sure. I mean, for sure, because you've got, obviously, at any time, if a market, and obviously going back to early February, you had a very overbought market. When you get something like an uncertainty of a war, it's obviously going to change the psyche of investors. It's obviously going to have them. It's actually remarkable that we're where we are. I mean, people forget, in February, yeah, it was before Iran.
Markets keep treating geopolitical fear as temporary, while ignoring the permanent damage currency dilution does to retirement savings. David Hunter's argument suggests metals are beginning to trade less on headlines and more on investor recognition that central banks cannot normalize debt-heavy systems without breaking growth. Gold holding elevated levels despite war volatility tells you institutional capital still wants protection underneath the surface. That matters for ordinary savers because stagnant purchasing power quietly destroys wealth faster than most market corrections. Next, David Hunter exposes why metals refusing to break lower may already contradict the Fed's inflation narrative.
It was either February or early March. Silver was down to 62 and $62, and gold had fallen down to 4,200. I think it was. Maybe it's slightly below that. We're above those numbers. The Iran war is not resolved yet. It's remarkable. They've held steady. I think the look there is very bullish. We've got wedge pattern in both that look like they resolve to the upside in a pretty vertical way. So I think it's just a matter of probably days before we're off to the races again. Who knows for sure? But I do think it's going to be a strong summer, and you could get all the way to my targets by Labor Day. You might not. If it stretches, for another month, 2 or 3, who cares? But I'm just saying it could happen that fast, that we go from, silver at 73 to silver at 200. We could go, gold at 4,400 or slightly below to gold 7,000. Those are remarkable runs if they can happen in the next 3 or 4 months.
Interesting. We're looking at these outlook for silver prices, for gold prices, and UBS at the CNBC website. UBS recently came out and said silver's breakout 2025 rally has created the conditions for demand destruction among buyers of the precious metals, according to analysts. We love all these unnamed people. But David, at what price do you see demand destruction occurring with silver?
The same price stabilization appeared before previous commodity accelerations, right when mainstream analysts declared demand exhaustion. According to David Hunter, metals holding above their February panic lows, despite unresolved geopolitical stress, signals underlying strength. Most traders are missing. Large funds rarely chase momentum publicly. They accumulate during emotionally exhausted consolidations, when retail confidence disappears. If silver can maintain these levels while rates stay restrictive, it raises uncomfortable questions about how fragile confidence in fiat purchasing power has already become. Next, David Hunter reveals why institutional demand may be stronger than public commodity forecasts admit.
I mean, we're looking at a $200 price target, and that demand destruction, would it come from a price spike, or would it be continuous, maintain elevated silver prices to cause it?
I'm not sure where they're coming up with that. You never know exactly whether somebody's got a preordained view of where silver should go after a big run, and so they're coming up with a reasoning, a rationale for that, or what. But we all hear that the amount of silver required in all these new technologies, including AI, in EV, obviously, in solar panels, etc. Silver demand is growing. It's not shrinking. And yes, I think I know where it's coming from. There's been talk about substitutions with copper and things like that to try to, and that's an economic postulate that's been around forever. Is when prices rise for one good, you find a substitution if you can. So that can happen at the margin. I don't think it changes the supply-demand picture in any meaningful way that would cause silver to sell off in any big way. And those changes happen slowly. You can't immediately just say, okay, we're substituting copper for silver, or we're doing this or that, or we're just going to stop production because silver is too high. So, and you've obviously heard the government say we're going to include silver in those strategic metals that we need to kind of make sure we can keep the supply coming.
UBS warns about silver demand destruction, while governments simultaneously classify silver as strategically necessary for future infrastructure. What David Hunter is highlighting is the contradiction between public caution narratives and institutional behavior surrounding AI systems, solar expansion, and electrification demand. Substitution stories sound convincing in headlines, but industrial transitions happen slowly while physical supply constraints tighten in real time. Investors focused only on short-term pullbacks may miss how aggressively strategic resource positioning is already happening behind closed doors. Next, David Hunter points out the specific supply contradiction hidden inside mainstream silver forecasts.
So I think you and the other thing about silver is it is a monetary metal as well. It's yes, supply demand from an industrial standpoint is more important silver than gold, but silver is still poor man's gold. When gold moves, because it's $4,400 on its way to $7,000, there are lots of people that would prefer to buy silver at $75. So I think it has a monetary component, even though it is more of an industrial metal than gold is. So, I could be wrong, but I don't think demand destruction is the reason to be concerned here. I will say where I think demand destruction will take place is not for that reason so much, but because I have a global bust forecast for next year, could start late this year even. But if we go into global bust, which, just simply I'd say is something along the lines of 2008-9, where you have a big financial crisis accompanied by a pretty severe downturn in the economy. If we see that, you're going to see demand in all industrial goods, fall, and silver will see that as well. So that's where I think you can get the big correction in the metals. If I'm right about targets or anywhere close, you could have gold at 7,000 and see it fall maybe to 4,000 or below, and certainly back to 4,000 in a bust.
The financial system keeps calling silver an industrial commodity, while investors increasingly treat it like emergency monetary insurance. This is where David Hunter's thesis shifts, because the real threat may not be temporary demand weakness, but a broader credit event resembling 2008 with sovereign debt layered on top. If global growth cracks under tightening liquidity, metals could initially sell off alongside everything else before confidence in fiat systems deteriorates further. The distinction matters because short-term volatility often hides the longer-term monetary reset underneath it. Next, David Hunter unravels why violent corrections may actually strengthen the long-term case for precious metals.
If silver goes to 200, and I'm right that that's where it goes to, silver could fall by more than 50% in a bust. So that's where I think you'll see the big correction. And by the way, that should not be something that shocks people. We just came through silver going from 122 to 60, to basically the low 60s. So it got cut in half in a matter of days or in a matter of a couple weeks. So it's not beyond belief to say that in a global downturn, silver could get hit by more than 50%, and gold could get hit by certainly 30 or 40%. So that's where I think you do get a big correction. And then coming out of that global bust, my longer term forecast for gold and target for gold is 20,000. My long-term target for silver, which for a long time was $400 or $500, I raised that to 1,000 recently. So I see that as probably sometime out in the early 2030s. So you have to go through probably a weakness next year, and then 28 to say 2032 could be unbelievable in terms of the kind of price rises we see in the precious metals.
Most investors think volatility disproves the metals thesis. But historically, extreme volatility is exactly what major monetary transitions look like. David Hunter notes that silver already proved how violently liquidity shocks can hit even structurally bullish assets during risk-off periods. The overlooked issue is that governments drowning in debt rarely solve crises through fiscal discipline. They solve them through currency debasement, yield suppression, and monetary expansion that eventually reprices hard assets dramatically higher. Investors focused only on short-term drawdowns may completely miss the larger wealth transfer unfolding underneath.